why don't we watch this video together?
Okay.
Let's do it. All right, let's watch it.
So if you want to save money on your payment, you're probably not going to expect me to say this, but there is literally one question you can ask. And I can guarantee you thousands of people that bought homes this year, if they would have just asked that one question, they could save at least $1,000 on their payment. And the question that you want to ask every time you find a property that you like is you want to speak to that listing agent and ask them if the seller is on an FHA mortgage. Because if they're on an FHA mortgage, that means you can assume their loan. Essentially, you can transfer their mortgage into your name. And the reason why you want to do that, right, is the biggest problem that we're facing is interest rates. So instead of you getting a new mortgage at a 6.5% rate, if you assume their rate, the likelihoods are they refi in 2020 or 2021, they'll likely have a 3 or a 4% interest rate. Instead of having a 6.5, you've got a 3% now. You're literally saving thousands of dollars a month on your payment. So if you want to save money on your payment,
How do you like that? So yes, it can be done, bro. But let me share you my screen and why I feel like we need to rebuttal this, okay? Not that there's anything wrong with it. He's saying that you can save thousands.
you're literally saving thousands of dollars a month on your payment.
Right? So let me share with you what these thousands technically actually quote unquote look like. Okay. So basically I'm going to use the example that we just had on the closing for okay. So they basically sold their house for $400,000. The gentleman says that you can save thousands, right?
Yeah.
So this is the loan that they're paying off. They bought it in 2021, a little less than 2 years from now. How does this make sense for the seller? When you're assuming a seller's loan, that's great if they allow you to have that. Their interest rate was actually 3.125, but at the low, it's roughly about 2.25, okay? That was the lowest it was. In that situation, if they're assuming the loan, okay, they're saving almost $500, which is actually a pretty decent savings, wouldn't you say?
Yes, it is. Compared to if it was today's rates, right?
Correct. But if they're selling the house for $400,000, and again, theirs is a very unique situation because usually by this time, because the market kind of changed and everything like that, otherwise they would have been able to sell it for probably $450 if it was in last July, right?
Yep.
You would think? Okay. So assuming, okay, that you're assuming the seller's loan, you gotta have to understand what's in it for the seller. The difference between $400,000 and the loan that you're assuming is almost $39,000, right?
Yeah.
So let's just say you assume this loan, you have to either take a second loan, which means the seller's lender has to agree to give you a second loan. Most lenders don't have the product to back up a second loan for an FHA, Chia.
Wait. Second loan as in because they're assuming the first loan.
Yes.
Oh, the difference
You
of today's
see?
market.
Yes.
So the second loan will be based off of today's rate.
Yes, the second loan is based on today's rate, okay? So it's a line of credit or a second loan and everything like that. But we don't even do it. That we have a second loan and an FHA loan. So how would be the difference? Where would be the difference, right? You as the buyer have to come in with the difference. Otherwise, what's in it for the seller? If they're not making any dollars at all, okay, how are they going to pay their agent? How are they going to pay for their own closing costs and things like that, right? This method is great for somebody that's doing a VA loan, the FHA loan, that is doing family to family, and they're not really looking for a profit at all. They just want to let go of it, okay? Mm-hmm. That makes sense. In a market where it's like 2008, where people were losing equity like crazy and they just wanted to get out because they couldn't afford their mortgage anymore and somebody else could, that makes sense. In this situation, even if we're doing this here, if there's a difference of $39,000, okay, Chia, and the lender typically will not give a second loan, what do you do then? If you took the same amount, okay, that same difference and got a loan instead, a one loan, even though it's at 6.5%, it is that difference, but you won't have to come in with that additional $39,000. Does that make sense? Because if you couldn't get a second loan, that's fine, okay? That's fine, but you're gonna have to come in with that amount, okay? And that is a difference of $600, okay? If you did that and you had that amount, sure, you could totally do that. So let's just say they sold their house for $450. It's almost 20%, right? Actually, I'm gonna make it 20%, so it makes a little bit more sense. Okay, there's no MI. You see, with FHA loans, there is a mortgage insurance, okay? If let's just say, for instance, if they weren't doing a second loan, sure. If they're going to put that much money in, sure, they can absolutely do that. Okay? They can absolutely do that. The issue is here, the seller, if they're going into another FHA loan, they can't, because they can't have two FHA loans at the same time. So what's in it for the seller? Can it be done? Is it beneficial for the buyer? Yeah, but it may not be beneficial for the seller, and most of the time it isn't as beneficial to the seller. So therefore, even though it exists, it kind of doesn't. Make sense?
I mean, it's a great
totally
idea.
Yeah, it's not a bad idea. It's not bad and everything like that. But to say that there's a possibility that it can save you thousands.
You're literally saving thousands of dollars a month on your payment.
Even when it benefits you, it's not that in the thousands, guys.
It's just another. It's another product for the consumer to decide if they want to utilize it. But of course, it's not just their decision. The owner of the home also have to decide whether or not they like the product, right? So then this just reminds me of FHA 201k.
203k?
203k.
Yeah.
203k, right? It's great for the buyer because then he or she could utilize it as a rehab loan, right? But if the seller doesn't want to take on that loan, then you can't even use that product from your lender.
Correct.
So it makes sense. These are all just different type of products then.
Yeah, just different type of products. And yeah,